Okay, welcome everyone to Trading Coaches Playbook. This is Brandon Wendell with you, and I apologize for my tardiness. I had it slipped my mind I was doing this today, so they reminded me, and I got in here as quickly as I could. So we'll go ahead and kick this off. Again, Trading Coaches Playbook. Quick reminder: we're not broker dealers or investment advisors. We're going to be looking at this information from an educational standpoint. We're not telling you to buy, sell, or hold any particular securities or giving any personalized recommendations about the markets. All markets do involve the risk of loss. That's always a situation. No matter what we do, we can never eliminate the risk. We just try to minimize and manage it. We are also not subject to trading restrictions. We get positions and security initiate them at any time. And we do stay pretty busy here at Wealth Builders HQ. As you can see, I got a lot of premium online workshops going on, a lot of free workshops as well. We got the Trading Coaches Playbook every week. I'm doing a free Kick-Ass with SPX workshop going on for the next couple days. Well, next week actually is the next several of them. And I'm also involved heavily in the E-mini think tank. So you can check out our website, wealthbuildershq.com, for more information on those. The E-mini think tank is a program that I run. You see, I've got that right here. Where basically I'm looking at the markets 3 days a week with my students and trying to find great opportunities, and I'm educating them in the meantime. And that's kind of what I'm going to be talking about today is one of those education pieces. If you go to, let's see, well, this is my E-mini think tank. As I mentioned, there's a mix of trading opportunities and education all kind of rolled into one. And as this loads up, you'll see that I have bonus material with new trainings. I'm re-recording all the videos that were previously done, as I have, well, not just class, but bonus videos here for different strategies. And also with all those strategies that I teach, I have documentation that goes along with it to basically help teach you how to do these different strategies. Thank you, Kevin. Kevin says E-mini rocks. I like to believe that. But basically, one of the strategies that I follow kind of on a regular basis is the novice candle opportunity. And I want to talk a little bit about that. When you go to learn about trading, there's a lot of resources out there. The problem is many of them can be kind of misleading. If you were to go out, I haven't done a search in a while, but if I were to go do a Google search here, let me see on trading. Let's say we do, yeah, just trading. And obviously got a lot of ads here for different things, but trading strategies, it's Wikipedia, Robinhood, all kinds of good stuff in there, right? But then if you narrow it down a little bit more, or even look at a lot of this, a lot of them are going to be about breakouts or breakout trading strategy. That's probably what I should have done. Because almost every single book that I've ever read has something about breakouts, the anatomy of trading breakouts or different strategies. There's tons of videos out there. And it's funny because there's so many pieces about breakout strategies. And what I found in actually trading the markets over the past 30 years, which I've been active, and I started trading, I actually started as a broker in 1996 and then moved into back office operations as a trader for the brokerage. And then I've been, like I said, trading for myself after I was trading for a hedge fund. I was trading for the brokerage. I did all those kinds of things, but trading for myself since about 1998, I guess. And in all this time, I found that most of those breakout trades tend to fail. And the problem, you'll see this quite often. There's actually a picture of it right here on the screen, as a matter of fact. Let me get rid of the indicator for now. Let's see. Actually, just delete it for now. There we go. And bring in volume. There we go. What you'll see is most people are enticed or kind of swindled, I suppose, into trading breakouts. When prices are breaking out of prior highs or breaking down from prior lows, people jump in and try to chase price. Well, there's a little bit of a high volume on gold right there. This is a continuous contract. I might actually see a little bit better with a specific contract. So let's see, GCM 2025. Try that. Just a little more detail sometimes. And no, not always, but in this case, you can see when prices were moving up, I happen to be on a daily chart. We broke out of prior highs and the volume jumped just a little bit over previous candles. And what happens? Prices come right back to try to shake some of those people out. As a matter of fact, really the big volume came in right here. Look at that jump in volume as we were breaking out of the sideways movement here. So what happens? Again, most of the books that you see on trading are telling you to jump in on these breakouts. There's tons of patterns out there. As a matter of fact, I showed this as a resource. It's not really a great resource, but the patternsite.com, this is an old website, as you can take a look right here, obviously. And if we go to, say, chart patterns, he started this in 2005, Thomas Bukowski, and I guess he re-edited some things in 2020. But you go to chart patterns, for instance, and actually he's been updating some. But when you look at the efficacy of these patterns, let's see, what do I have? I'll just do it. Alphabetical index, doesn't matter. And let's say we do double top. So double top, where's that? Oh, these are candle patterns. Sorry, I'm in the wrong spot. Chart pattern is what I needed. There we go. Index, we'll just stay there. C, D, there we are. Double tops. And there's so many different kinds that they go into, but ugly, busted. There we go. We'll go to double top, atom and atom. Doesn't matter. But you take a look at these tips, and right here, you can see that they don't follow through all that great. Break even, failure rate, 25% average decline, percentage meaning price target, only 64%. And that's based off of 1,100 perfect trades. So when you start going into these, and I think there's a pattern ranking, I might have missed that one. It's been a while since I've been in here. There's a bunch of different books he's written. I'm not saying this is great. I'm just talking about it. But see, pattern rank. There we go. Based on performance. And one, they talk about bump and run reversal bottom, which is the best, and then rounding top. So again, if I go back to the index, bump and run reversal bottom, which is the best of the best. Nope, I got to go back to the index somewhere. Where's your chart patterns? B, bump and run reversal bottom. Supposedly, this is the best of the best, and this was updated about 5 years ago. And number 1 out of 39, break-even failure rate, 9%, average rise, throwback, blah, blah, blah. It only meets the price target 76% of the time. So these patterns are not wonderful. They're not spectacular. And here's something else that usually happens that they don't mention. They get pulled back and shake you out. For instance, here, this is called the lead-in phase, the bump phase, the run phase. You're supposed to trade this breakout. Most of the patterns require you to trade breakouts. And what happens is that many of these breakouts shake you out first. Think about this. And I'll get back to that gold chart in a moment here, talk about that. But if prices are going to go up, okay, how do prices physically move up? There has to be a lot of buying pressure for prices to move up. You can't go up without buying pressure, period, right? What happens physically is that there's a lot of buying, and the sellers realize that there's either very few sellers altogether, and the buyers have to attract those sellers by raising their bids, or there are no sellers in the area, and the buyers have to keep raising their bids in order to get to where the sellers might be interested. So if everybody who wants to buy does, think about this right here, this gold chart. If everybody wanted to buy, was getting in as the prices were already rallying, or right here as we're breaking out, again, notice the spike in volume as we break out. That is an exhaustion of the buying pressure. Everybody wants to buy, just did. Can prices continue to go up if people are not willing to buy? No, it can't. How can prices go up without buyers? They can't. So what typically happens is they rise a little bit as, again, more latecomers come to the party because they read these books on breakouts. And in this case, it did go up a little bit, and then it pulled back. Now, think about this. All those people who are buying in this area on the breakout, what do you think that they have placed just below that breakout point, right? They're buying on the breakout. Yeah, so they're buying on the breakout. So they're going long there. Obviously, just below that, many of them are setting sell stops. Right? Well, the pros are not stupid. They see this happening all the time. I mean, literally, I used to do this for a living, working at the brokerage. I was a trader for the broker, and was tasked with getting order flow filled and also making money for the brokerage itself. So we had to learn a lot of these tricks that were going on and how to separate other people from their money. Money just doesn't appear in the markets. It is taken from other accounts. The uneducated, unknowing pay to the accounts of the people who are educated and do know. That's pretty much what happens on a regular basis. So if you understand, sorry, I just got a message here. If you understand what's happening, you can take advantage of this too, rather than getting taken advantage of. It's much more fun to be on the winning side, right? So if there's a ton of sell stops just below this line, you better believe once all that buying pressure exhausts itself, again, all those people are buying, 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 and eventually the buying pressure is gone. It's exhausted. Oops. And of course, prices start coming back down. Maybe there's some lucky people who are able to sell. You see, there was pretty good volume there. But often what will happen is not only were the novices chasing price all the way up, again, they chase and chase and chase. See, as a professional, the way, and I've mentioned this before in some of my previous sessions, when you have a large order, okay, the font a little bigger, yeah, I could try to. Basically, when you have a large order as an institution, and you usually are trading pretty large order flow when you're an institution, you cannot put in your order all at once. If you do, everybody's going to see it and they're going to front run you, right? Because they're going to know, worst case scenario, I could just go ahead and sell to this sucker that needs to buy a lot more. So what you do as an institution is you break up your order into smaller pieces. There's a term for it. It's called working the order. So you basically work the order in and you decide before you put your first order in, you decide on the average price where you're willing to pay or willing to sell at. Okay. So if prices leave that average area, you automatically stop your orders. Everything's done electronically now. So you basically type in the average area that you want to buy or sell, and the computer works the order for you now. I was actually contracted a while back by a uh, money manager who had about $50 million actually 60 million assets under management. And he was asking me, how I'm having trouble getting all these orders filled for all my customers. How do I do this? So we ended up meeting up in New York at our office, and I mentored him on uh, basically working the order, how to do it properly. So basically, what's happening here is the professionals will average in a certain area. Once we go beyond that area, they will stop. So basically, all this volume that's happening after breakouts is typically the retail customers chasing price. That's my point. Pros don't chase price. If they do, they're not pros for very long. So if they see that all the buying pressure is gone, they'll start selling. And you can see there was indecision here. There was actually a battle in this case between buying and selling pressure. And I know that because I can read price properly. Okay. When you want to learn what's really going on in the markets, one of the main things you need to do is learn how to properly read price. Because what's happening here is a story is being told about the markets, in this case, gold, but it could be any security, it could be futures, could be equities, could be Forex. It doesn't matter. It's all the same. We are really seeing a trail of breadcrumbs of what traders anticipated would happen in the markets and the actions they took. So when it comes to reading price, I say there's really four key things you need to learn: color, shape, size, and location. Okay. And with these four, once you learn those things, you're way ahead of almost everybody else. You're also way ahead of the indicators because technical indicators, while they can be somewhat useful, they're all lagging. They are based on the closing price of the candle. So that's basically a late, it's after things have happened. So you always get buy and sell signals after. What I really need to do is be able to anticipate what's likely to happen based on color, shape, size, location. And as I said before, in the E-mini think tank, this is under my fundamentals, believe it or not. We have things right here with my pre-trading routine and zoning technique. I have created lessons on this and they're all recorded. I mentioned there's the bonus videos here. All these bonus videos, I'm redoing them as we speak. You can see they're popping up as new trainings. I've got 2 of them completed, and there's still a lot more I'm doing. But what I'm teaching is, and these are nice because you can watch these whenever you want. There's not a pressure to try to grasp everything all at once. You just watch it at your own pace and learn. And of course, if there's any questions, you just message me and let me know. But anyway, where I was going with this is part of the core chart reading and being able to understand what's really happening and what's likely to happen is understanding color, shape, size, location. And when it comes to color, that one's pretty simple. It's basically you got either green or red, right? That'll tell you how strong the momentum is. And when I say momentum, that's also really trend. And when you apply this to different time frames as well. So it'll tell you how strong it is or how weak it is. It basically also warns of reversals or pauses. Shape is something I just kind of mentioned there a little bit. That's basically the closing price versus the high and the low. So those pieces are sticking out on top and bottom. We call those wicks because these are candles. They're also known as shadows or tails. And they give a story. I mean, if you close away from the high, that topping tail that's left is selling pressure because we couldn't close at the high. Buyers gave up and the sellers pushed us down to win. Bottom tails are the opposite. Sellers could not hold that level and buyers pushed prices higher, either because of lack of selling pressure or just because the buyers were much stronger. And that can give you a clue as to what's coming up. Okay. Size is the range of the candle. You get very large candles or large wicks, either large bodies or large wicks. And often large candles, and by the way, it's not just the body. Like I said, it's the wicks as well. Large candles can identify novice traders or pros, depending on the location. It basically is like a flag saying, hey, here I am, take my money. Or here I am, come trade with me. Whoops. Let me do that. Meant to move this out of the way. And location is supply and demand, which is something I believe very strongly in because I've been trading with it successfully for many, many years. So combining all this lets me know what is likely to happen in the near future as well as the far distant future, depending on what time frame you're looking at. The nice thing about charting and all this is that everything that you see can be applied to almost any time frame. Okay, time is fractal, or price is fractal. Fractal means the small pieces are the same shape as the whole. So what I use on this daily chart can also be applied to weekly or even a 15-minute chart, doesn't matter. So as I mentioned, that size of the candle, when you get a large candle, let's see, we'll change colors here for a little bit. So if we get a large ranged candle in the trend direction, that's usually novices. And it'll especially be the novices, or probably stand out more if, again, it's large after the trend has been running, or it's a breakout to a new high, or a breakdown to a new low. Again, a lot of books I showed you, a lot of stuff has been written about breakouts and breakdowns. It's very, very popular style of trading, and it's useless. It really can be. Number three, you'll also see increased or a spike in volume. Now, I know they say the institutions do most of the volume, but when you get a lot of novices individually all jumping in at the same spot, you'll get these spikes and jumps in volume. So it's not always going to have all these things, but often that's what you're going to see. And what will usually happen is the novices get shaken out. Either they jump in at the end of the move, and what I would see to know if it's the end of the move is I use multiple time frame analysis. So if I'm trading on a daily chart, this trend will usually end at a much higher time frame supply zone. And the same thing works intraday. Sorry, I'm having allergy issues today. Wind keeps blowing around, weather's changing here. So you can see that in this case, what happened? Price came back, shook out the novices, and prices continued up again without them. No, it didn't continue far in this case, but it did continue up to a certain amount without them. And the reason why, I said this before, if everybody jumps in, there's nowhere else for prices to go but the opposite direction, because there's nothing to keep prices moving in that same direction. So there's an old saying about the markets: prices move further and faster with the least amount of people on board. Prices move further and faster with the least amount of people on board. So let's go to a different time frame. Actually, I'll go to a different security altogether. Let's do crude oil. And let's see, 60-minute. Actually, we're examples on all different time frames, so it doesn't matter. But excuse me. I mentioned, here we got some examples. They're all over the place, to be honest with you. Oh, here's another good one. I keep finding one. I'm like, oh, wait, no, there's another good one. There's another good one. Like right here, we're moving in a downward trend. We get this little pullback, and as we break down to fresh lows, look what happened with the volume. Big spike in volume. Okay. Moving in a downward trend, we get a candle to the downside. And basically, we actually broke out of the lows right there. Look what happened. We came back to retrace and stop out those people who were jumping in late. Or back here, we're moving off these lows. As we're moving off the lows, same thing. We get to an area that we're breaking out of a prior high, and we get that big jump in volume, right? These spikes in volumes are giveaways that we might be getting a change in the trend, or at least a correction. So again, there's another big jump in volume based on the expanded range candle right above it. And to a lesser extent, it didn't really happen here, but you can see there's a little bit of a spike in volume as we got a little bit bigger on the candles and reversed. So like I said, if I'm looking at a 1 hour time frame, how do you determine a head fake in the volume? Oh, what do you mean by head fake? Like if it's a false move and it breaks the other direction? That's usually if you're coming out of consolidation. Yeah, it's usually if you're coming out of consolidation. I don't necessarily look at the volume for that. I look at the direction of the basing. So for instance, right here, we're moving in a sideways consolidation. The majority of the time when you leave consolidation, you'll go the same way you entered. We entered downwards. We go into this consolidation, we should enter downwards or exit downwards, excuse me. So Yeah, that's one thing I'm looking for. Now, how do I know if it's going to be a continuation or a pause? Like this one, for instance, we're moving down, 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 down. We retraced back to almost the breakout point before we continued down again. How do we know that's not going to be a reversal in the trend? I mean, this is what we see at the time. Oops, right here. We see prices moving down, all of a sudden acceleration with big volume. We got to determine, should we stay in with a tight stop or should we get out and take our profits? Is this going to be reversing or are we simply pausing? Well, as I said before, I typically use multiple time frame analysis to let me know. If I'm trading on a 60-minute time frame, this lower time frame, I call it my zone time frame. Yeah, that's where I'm entering and exiting. By the way, I don't expect you to remember all this that I'm talking about today, just kind of showing you what this is all about. The big thing is to avoid jumping in and chasing price, because that's typically where the novices are. But I do teach all this in much slower methodical manners in the E-mini think tank. So if you're interested in learning more of this in a better way and being able to apply it as well as see it applied on a regular basis, you join me in the E-mini think tank. So anyway, I have that lower time frame for entering and exiting. I then have my intermediate time frame, which I call my trend time frame, and that's for direction to trade. Tells me which way I should be trading. Well, trends don't go on forever. There's a higher time frame, or what I call the perspective time frame, and that is where the trends end. So for me, on this 60-minute time frame, the other key thing is to know what time frames you should be looking at. There's a relationship between time frames. You can't just go from a 60-minute to a daily. You might be missing trends that will influence what you're trading on. Or you can't go from a 5-minute to a daily. Okay, obviously there's intraday trends that will affect the price that you're trading on. So you got to make sure you use the right multiples. And again, these are all planned out. Pretty much everything I do when it comes to trading is done according to structure and plans. Again, they're all dictated right here. Charting techniques. How do I identify certain opportunities, different styles of trading, strategies, individual strategies that I might apply. I write them all out, even fundamentally. How do I identify zones? How do I identify trends? How do I identify quality when it comes to my trades? The reason why it's all dictated and written out like that is because that can create consistency. If I'm just simply doing whatever I feel without any kind of structure, I will not get consistent results. But if I follow a plan and rigidly adhere to that plan, I should have the same results. Now, if I don't like those results, I can edit the plan and see how it adjusts. If it gets better, I fix it. But if I'm not following a plan, just kind of jumping around doing whatever, and things are not working out the way I want, what do I know? How do I know what to fix? I don't. If you're day trading, what time frames should you be using? It depends, to be honest with you. It depends on your goals and how much risk tolerance you have. I always say you want to use the highest frame you feel comfortable using. So again, let me just keep this chart here for a moment and go to this one instead. So let's say we want to trade the Russell 2000. Okay. And I want to do some intraday trading. I could go down to 1-minute charts. I could use something called a tick chart or a volume-based chart. Obviously, I will have very little risk because my zones will be very, very small. In this case, it's about a 1.3 points of risk. So it's over over $50 of risk. This 1 point is $50 here. So we're looking at about $60 of risk on a 1-minute chart. And that was a supply that if I had sold, I would have made a little profit. I can go to a 5-minute chart. And now the zones might be in different locales and they'll be a different size. In this case, I have a little rally base. Well, maybe be wider than that. So now I'm over 3 points of risk, $150. If I'm comfortable, maybe I do a 30-minute. Typically, if you're day trading, you won't want to go larger than 30 or 60 minutes because if you do, you're not going to reach your targets in time. So for instance, now I have this supply zone, which is 8 points wide, and it worked. So you want to go with whatever time frame you feel comfortable trading on. Like you just saw, I went from the 1 minute chart with about 1 point of risk to a 5 minute chart that had 3 points of risk to now I'm on a 30-minute chart that has 8 points of risk. So I either had $60, I had $150, or now we've got $400 of risk. It's whatever you're comfortable with. Keep in mind the bigger zones on the bigger time frames are also going to be further apart. So that means you get more reward using less trades. So there's not a perfect time frame for everybody. It's just whatever you feel comfortable trading on is really what it comes down to. I wish I had a more definitive number, but when it comes to what I should be using for each of these time frames, I definitely do have a definitive number. So if we're looking at this and seeing a novice candle right now coming in, I will go to my bigger time frame. So instead of this 1 hour, I'll look at the 4-hour trend. Let's see, where were we? Here's my 4-hour trend. And I would look to see certain tools that would tell me whether or not this trend is likely to be pausing or ending. And of course, I'd even go bigger, perhaps to a daily chart, and look to see again. Oops, there we go. As we coming into that or getting that novice candle, we are not at daily demand. So what does that tell me? We're not going to finish this downward trend yet. We're still going down. So that means what I was experiencing here with this candle is nothing more than a pause in price. It's not a reversal. That's it. Keep it simple. Oops, sorry. Phone is going crazy today. Oh, okay. So what happened? We retraced back to shake out the novices and then continued on. On this one, same thing. Is higher time frame, longer short time. It's higher than the previous one. So zone time frame is the smallest time frame, intermediate is a little bit bigger, and higher time frame is the biggest. And when you say long or short time, that is objective or subjective, sorry. So it could be, it doesn't have to be long. It's just, again, it depends on what you're trading and how you're trading it. So there's no real way to definitively answer that, say, oh, it's long time or short time. In this case, when I was using 1 hour, I went for 4-hour trend and daily perspective. But if I were to use maybe a 5-minute chart for my zones, lower time frame, I might use 30-minute and 3 hours. Is that long or is that not? Again, it's personal preference. It's whatever you think. Let's see, who's that? Oh, okay. Sorry, I was looking at the camera. I heard a vehicle on the property. It's a contractor working here. Anyway, so here's another novice breakout. Again, I pointed out that we're trying to break out of prior highs, most recently right in here before we dropped. You got that spike in volume, novices chasing price. You don't want to be one of those guys because what happens, again, they're setting their stops up below that area, expecting prices to continue up. And pulls back to shake them out. And like I said, I actually have rules surrounding that. I think it's under breakout trades. There are specific times I will do breakout trades, but the majority of the time I will not. For that reason, it's the novices chasing. But there are opening range breakouts and there's news breakouts that I will. But look at this. I have a trade called the novice shakeout. And this novice shakeout tells you exactly how to trade what we're seeing right here, which is novices jumping in late. Again, it's a large range candle compared to the candles before it. It's occurring after a move up in price. So it's the novices jumping in and the spike in volume is there. So what's likely to happen is prices will most likely pull back and give you an opportunity to buy from all the stop losses being triggered. And of course, there it is, stopping out all those people who jumped in on that breakout. And what happens after it starts moving up typically? What do you think is going to happen here? Everybody who got stopped out is now thinking, oh, I was right. I got stopped out. I better get back in. And what do? Boom, volume goes up and they drive the prices higher, hopefully with you on board. Now, this was towards the end of a day, so it died off first, but it typically does that. It'll follow through. Again, I could do this on a currency even, Euro US dollar. And you'll see this example over and over and over again. Let me clear my drawings here. And there's one right in our face, right there. A couple of them actually, right here. First of all, we are breaking out of these prior lows. We're doing it with high volume after we're already moving downwards. So what's likely to happen? There's the pullback to shake everybody out before we can go lower. There's another one. Prices are breaking out. Okay. There's your pullback to shake everybody out. And this was actually a reversal. So those are things that I can look for. It happens to be on a 1 hour chart. Again, I can go to different time frames. We can go to a different security, say Amazon stock, and look for these things. Look at this. It's crazy. Moving down, 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 down. You don't have to look that hard. They're around everywhere. There's that breakdown, spike in volume. What's going to happen next? Bye-bye money. It was the end of the move. Why was it the end of the move? We were in a 5-minute time frame here with a novice candle, right? We would be trading a 30-minute downtrend if we had it. And actually shouldn't have been shorting anyway because we were not in a 30-minute downtrend at the time. And if I look at the bigger picture, say 180 minutes, 3 hours, and we didn't really have any demand, but we do kind of have a little basing and rally out of that area. So you definitely wouldn't be shorting in front of that. So again, I'll go back down to 5 minutes with the stock again. And the difference is this is a professional candle. This is a large green candle that's occurring after we were moving in which direction? We were moving down, not up, right? That's a big difference. Because if we were moving up already, it would be the novices, kind of like this. Here you can see moving up, pull back, moving up, pull back, moving up, pull back. And notice this one and this one, oops. Both of those candles occur at breakout points from prior highs. Isn't that crazy how often it happens? And look at the volume. Spike in volume. Yeah, spike in volume, right? And what occurred on each one of those? Prices pulled back to shake those people out for buying after prices moved up. Right there again, broke out, pulled back, shake them out before going higher. This one, though, is different. This is not a breakout. It's not chasing price. It's not even moving in the same direction. Remove these. This candle is moving up after prices have been moving down. Those are the pros. And if those are the pros, that's the start of a move typically. And not only is that a pro move, but look at how it ended with the novice again. Yeah, I can look at SPX. Oops. 5 years ago, you remember the novice group. Now you'll send them a thank you for letting me know, letting me have a piece of the pie. Yeah, exactly. Hey, I've been there. We probably all have. So again, look at the spike in volume. This also had a little bit of an increase in volume compared to the ones around it, but not at spike. Because the pros, again, try to buy, they're buying when everybody else is pretty much selling. But they're near the end of the selling move. So there isn't a whole lot of selling pressure left. So they'll take what's left before prices reverse. And that means there may be a lot of leftover orders here. So if prices return to this area in the future, there may be a lot of buy orders that did not get filled. Anyway, this is the novices chasing late, and they're pulled back before it went higher. And I don't know if that was a breakout or not, but it doesn't matter. We even had one right here just before the high. Again, it's not a gigantic candle, but is this candle larger than the ones before it? Yes. Does it come after a rally in price with a green candle? Yes. Does it have a spike in volume? Yes. Check, check, check. It's a novice candle and the end of the move. So now I'm curious to see this pro candle that I was talking about. Is that actually marking a buying area in the future? Because that's typically what happens with the pros. No, not yet. Actually, no, it wasn't. Nope. But if we come back down, that's likely to be an area that buying pressure would come back because that's where the pros bought before. Try to see if there's a good example in the past. I see a lot of novices. That's for sure. I'm not seeing as many pros. Again, here's another novice. It jumps out. Big spike in volume. Oops. Alt B. There we go. Actually, the volume came on this candle, which was technically the breakout right there. And then we got another big candle, and there it is coming right back at the end of the move. Why? Well, this is a 5-minute time frame. If I go to the 3-hour time frame where that occurred, where are you? We were at an area where prices had rallied, based, and gapped down in the past. So that's why I held it down again. It was supply from the higher time frame. So yeah, one of the things we want to make sure of is we do not want to get caught up with the novices and chase. That's a terrible thing to do. So yeah, if we would look at SPX, I think I got to use this one because I have one that's already marked up with zones. Now this is an index, so I won't see volume, but you'll still see candles moving that way. Oops. So again, if I go to a daily of the S&P or the SPX, pros starting to sell right there. Why? Because we're moving sideways after an upward move, and that's the start of a down move. Okay, no novices really. There's your novices at the end of the move. We had all those big gaps down and a large red candle. That's a novice candle. And we stopped moving down, started moving up. This might be some professionals coming in to buy off the bottom. So if prices were to come back there, I'd expect us to bounce again. If we go down to say an hourly chart, same thing. Again, I'll go back to random time frame. Clear this chart. And you can see, okay, this was moving up. Here's your pros near the beginning of the move. So this area and that large red candle, those are professionals selling after prices have been moving up. This one might be as well, although we already started drifting a little off the highs before that happened. Here's novices, here's novices, right? And after these novices, you can see they were shaken out. We went down lower, and this was the end of the move. This, oops, I keep going too fast. Pros again. As we're moving up, we base, and then we drop with the pro candle. So that means those are selling pressure areas that, look at that, price comes back to it and holds. It's a good selling area. Another novice candle coming in, perhaps. large candle, same direction we're already traveling. We might be nearing the end of the move, and we're breaking down to fresh lows. Sure enough, at least we did retrace, stop everybody out before we went down. And yep, we're near the end of a move, perhaps. Nope, maybe not. Still going a bit. So it's just a retracement. And let's see if we ever get back up. Remember, I marked off some areas that might be professionals up here. Let's see how the market reacted to those levels. Oh, we haven't gotten there yet. I thought we did. Well, if we get there, those should act as resistance level or supply, really. So that's a little insight into what's going on with those novices. And like I said, it's terrible that there's so many books on breakout trades and so many websites on it, but I guess we kind of need it because, like I said, the money's got to come from somewhere. So if those novices keep selling those or breakdowns or buying the breakouts, then it's good for us and the people who are in the know. And if you're interested in learning more about those specific strategies, like I said, I'd love to have you join me with the mini think tank, where I teach all this and show you the specific strategies and exactly how to manage the risk and the trade, getting in, getting out properly without overextending yourself in those particular situations. So again, I can switch this over to SPY. There I'll see the volume. It's pretty much the same thing as the SPX. And going back to those novice candles that I was pointing out before versus pros. Actually, this one doesn't have the lines drawn on it right now, but if I go back, you'll pretty much see the same thing. Anytime we get those large candles after a move in price, we typically get a large volume move with it. However, the pro candles don't have the big jump in volume, do they? That's a pro candle because we're moving up and turned down. Notice the difference in volume, much, much lighter. That's the key thing there too. Again, another novice candle, large range candle after move down, not so good. This candle though, we were moving sideways and started moving down with that. That larger candle has lighter volume. It's the pros. It's kind of interesting. I mean, there literally are signs telling you what to do. You just got to know what to look for. So hopefully you enjoyed this and gained a little bit of info. I've got to get going. I got a bunch of trades I got to set up for today. For the afternoon, that's another service I do, the SPX cash flow that I was mentioning. So like I said, hopefully you got some good info. This is recorded and it will be posted as well. I think our YouTube channel for Wealth Builders HQ, you'll see the Trading Coaches Corner, or Playbook, excuse me, Trading Coaches Playbook. So thank you for being here. Appreciate your time. And until next time, everyone, trade safe, trade well, and take care.